Still with us is our hedge fund analyst, H Schmidt, who spends his time looking at hedge funds and seeing whether they're worth investing in. And it's a nice theory. A hedge fund is going to give you some protection on the downside. It's going to, won't partake as much of the upside, but you still get reasonable returns. And many of these, actually, some of them saying 16% return over the last year. The question many investors will have, though, that's all very well, but I don't get 16% return because you've got all these charges, and the charges and the margins are much higher on hedge funds than they are on straightforward long funds.
They certainly are. We saw, for example, last year, 100 new hedge funds starting up. And the main driver, I would say, if I'm very cynical here, is were really the charges. When you can, in the traditional asset management, you charge 0.5% to 1% management fee per year, while in the hedge funds, the fees are between 1 to 2% management fee, plus a portion of the performance. Usually, hedge fund managers charge between 15 and 25%. The average is 20% on all profits. So they make a lot of money, not just on the management fee, but on the upside.
Right, so in other words, I mean, the real return that you're going to get is going to be much lower, isn't it?
You really get if a manager is up 100%. For example, the most successful manager in Europe at the moment, Roger Guy's Gartmore Alpha Gen Capella fund, which is a closed fund, you cannot invest into him, was up 100%. Investors really got 80% because 20% remained with Gartmore. But if you're up 100%, that's fine.
So in these markets, getting some kind of return is
and it's still up this year.
Yeah.
It's up every month.
All right. We'll look at the high net worth individual as well. So
yes.
if you actually want to, and this is the way you probably go more for a single fund than anything else. There are two that you've got here. Let's look at them in detail. The OD European.
We like the OD European. OD European has been around since 1992, is managed by the principal, Chris Spinode, a very skilled manager, very charismatic. Formerly, he was with Barings. He's been managing this fund since 1992. He had a terrible year in 1994, but since then, he really learned the lesson. It's a very, I would say, a conservative hedge fund, because usually hedge funds employ leverage. He never employs leverage. He's always actually deleveraged, meaning he employs less, he uses less capital than he has, or less equity. He was up 16% last year. He's up again this year. He was slightly up in January. He was up in February, 3%. And I think he's again up this month, which is very nice. And I think one of the reasons is that he's more conservative. You see, he missed kind of the tech rally. He was only up slightly in 99, 16% up in 2000. And now, in a difficult year, he produces again returns.
Yeah, in fact, actually, it's interesting, of course, with people like Tony Dye and Warren Buffett, all these people that sort of missed or said didn't really believe the tech rally, and now have much more credibility. So that's probably something to look at. Another one from HSBC Republic, European Absolute Limited. How do they play this? What's their strategy?
Absolute Limited is a retail fund. So I think we mentioned it earlier. I think we want to swap over to Thames River and the Gothic GVA fund. Thames River is a similar fund to ODE, managed by Tony Zucker, a very experienced fund manager. He's produced 33% last year. Very, very interesting, and that was net to the investor. He's slightly up this year. It's more difficult to trade this year, but it's a very interesting fund. Denomination is it gives access to both high net worth individuals and institutional investors. Interesting strategy, long short equity. Right. Finally, the last fund we really like is a market-neutral fund called Gothic GVA, which is a fund of fund which invests only in skilled strategies, into arbitrage strategies. So rather than ODE and Thames and other, which have long short, they only invest into funds which do arbitrage strategies. So they will never make the 33%, but they always make something between 10 and 15% with very good risk-adjusted returns.
Yeah. Which is still a decent return, even if you take off the 20% on that as well. All right, H Schmidt, thank you very much indeed for joining us.
Thank you very much for
looking at hedge funds. Well, let's get out and just talk macro.